This is a demonstration of problem M630A using variable and absorption costing, making decisions. The annual data that follow pertains to Mike's Magnificent Eyewear, a manufacturer of swimming goggles. And the problem states that Mike's Magnificent Eyewear had no beginning finished goods inventory in January, but it gives us the number of goggles that were produced and sold, the sales price per unit, variable manufacturing cost per unit, sales commission cost per unit, and the fixed manufacturing overhead and fixed selling and administrative costs. In the first requirement, it asks us to prepare both conventional using absorption costing and contribution margin using variable costing income statements for Mike's Magnificent Eyewear for the year ended December 31st. So using absorption costing, we're first going to calculate what our net sales revenue would be. So the problem told us that the sales price per unit was $28, and we would multiply that by the number of goggles sold, 230,000, and that would give us net sales revenue of $6,440,000. Next, we're going to subtract from that our cost of goods sold. The variable cost of goods sold would be equal to $10 of variable manufacturing cost per unit times the number of units that were sold of 230,000 or $2,300,000 in variable cost of goods sold. The fixed cost of goods sold would be equal to the total manufacturing overhead of 1,960,000 divided by the total number of units that were produced, 245,000, and then multiplied by the number of units sold of 230,000 or $1,840,000. Adding those together, we get cost of goods sold of $4,140,000. Subtracting that amount from net sales revenue gives us gross profit of $2,300,000. Next, we're going to subtract our selling and administrative costs. The variable selling and administrative cost is equal to $2 sales commission per unit times the number of units sold of 230,000 or $460,000 of variable selling and administrative cost, and the fixed amount was $260,000. So our total selling and administrative costs were $720,000, which, when we subtract that from gross profit, gave us operating income of $1,580,000. Next, we're going to do the income statement using variable costing and contribution margin. So we start out again with the same sales revenue of $6,440,000. And we're going to subtract from that our variable manufacturing costs, which we had calculated to be $2,300,000, and our variable selling and administrative costs that we calculated of $460,000, which gives us total variable cost of $2,760,000, which, when we subtract from net sales revenue, gives us contribution margin of $3,680,000. And from that, we're going to subtract all of our fixed costs. So our manufacturing fixed costs were equal to $1,960,000. And our fixed selling and administrative costs were $260,000. So our total fixed costs were $2,220,000, which, when we subtract that from contribution margin, gave us operating income of $1,460,000. In part 2, it asks us which statement shows the higher operating income and why. So using absorption costing, we had operating income of $1,580,000, and using variable costing, we had $1,460,000. So the difference was, of course, absorption costing was higher by $120,000, and that is because we had fixed manufacturing overhead costs that were included in ending inventory that would not have been included in cost of goods sold. So to calculate the fixed manufacturing overhead cost per unit, we take $1,960,000 and we divide that by the number of units that were manufactured of 245,000, and that gives us $8 of fixed manufacturing overhead cost per unit. When we multiply that by the number of units that remained in ending inventory that were produced but not sold of 15,000, we get $120,000 difference in the operating income. So we can see that when we see that the fixed manufacturing overhead in cost of goods sold was $120,000 less than the fixed manufacturing costs that were included using variable costing. Next, it states in 3 that Mike's Magnificent Eyewear's marketing vice president believes a new sales promotion that costs $40,000 would increase sales to 235,000 goggles, and should the company go ahead with the promotion. Well, we had calculated in our first requirement that the contribution margin was $3,680,000, and when we divide that by the number of units that we sold of 230,000, we see that our contribution margin per unit is $16. So when we take the contribution margin and we multiply it by the additional number of units that the vice president believes the campaign will sell of 5,000, and we subtract the additional cost for the campaign of 40,000, we see that we will still have additional operating income of 40,000. So Mike's Magnificent Eyewear should go forward with the sales promotion suggested by the vice president, because the contribution margin of $16 multiplied by the 5,000 units is equal to $80,000, and it's only going to cost an additional $40,000 for the campaign, which will increase our operating income by $40,000. And that is the conclusion of the demonstration for problem M630A.